Hello, and welcome to The Explainer. Listen, if your work involves long-term construction or service contracts, you need to pay close attention. A major change is on the horizon. Today, we're diving deep into Section 57 of the new Income Tax Act 2025. Trust me, this is going to fundamentally change how you recognize your taxable income.
So, let me ask you this. You're in the middle of a big construction project, right? It's going to span 3 years. How on earth do you figure out your taxable income for each of those years? It's a classic problem, isn't it? Revenue and costs are all over the place, not fitting neatly into one little financial box. So what's the right way to report your profits accurately and consistently year after year?
Well, the answer to that puzzle lies right inside Section 57 of the new Income Tax Act 2025. This section is the new rule book, specifically designed to bring some much-needed consistency and clarity to how we handle income from these tricky long-term contracts.
All right, so here's our game plan for today. We'll kick things off with the core principle behind Section 57. Then, we'll get into the nitty-gritty of the 3 different recognition methods. After that, we'll look at how to actually calculate the revenue and costs, walk through a real-world example, and wrap up with some crucial compliance tips to make sure you stay out of trouble. Sound good?
So let's jump right in. What's the big idea behind Section 57? Really, it's all about creating a new, streamlined framework for figuring out profits from these long-term contracts. The goal is simple, but it's super important: to make sure you recognize income methodically over the entire life of a project instead of just dumping it all at the end or guessing along the way.
Now, for those of you who've been in the game for a while, this might sound a bit familiar. You're probably thinking of Section 43CB from the old 1961 Act, and you'd be right. This isn't a total reinvention. Think of Section 57 as the modern successor. It takes the core ideas from 43CB, but it streamlines and updates them to align better with current accounting standards. The whole point is to make things clearer and more consistent for everyone.
Okay, so what does Section 57 actually do? In a nutshell, it forces you to use a specific method for calculating profits from your construction and service contracts. Why? To stop people from booking profits whenever they feel like it. It's all about creating a consistent, logical way to recognize that income year in and year out.
All right, so we know the what and the why. Now let's get into the how. Section 57 gives us a main default rule for recognizing revenue. But, and this is important, it also has a couple of key exceptions. You absolutely have to know which method applies to your specific contracts.
Okay, here's the #1 rule you've got to remember. The default method, the one you'll use for pretty much all construction contracts and most service contracts, is the percentage of completion method. You'll often hear it called POCM. This is your go-to, your starting point for nearly every long-term project.
But what about those exceptions I mentioned? Well, they're super important and they apply only to service contracts. So, exception number 1. If you've got a short service contract, we're talking 90 days or less, you can use the project completion method. That means you recognize all the income right at the end when the job's done. Simple. Exception number 2 is for when you have a contract that requires an indeterminate number of acts over a set period. In that case, you have to use the straight line method. You just spread the income out evenly over the life of the contract.
Okay, let's get down to brass tacks, the actual calculations. To use these methods correctly, you have to be crystal clear on what the Act considers contract revenue and contract costs. Believe me, getting this wrong is a recipe for compliance headaches.
The Act is very specific here. There are 2 rules that are absolutely non-negotiable. Rule number 1, your contract revenue must include retention money. I don't care if it's not in your bank account yet. For tax purposes, it's revenue. Rule number 2, you are not allowed to reduce your contract costs with any incidental income. You know, things like interest you earned on a deposit or a little profit from selling old equipment. That income needs to be accounted for completely separately.
Look, theory is great, but let's see how this stuff actually works in the real world. We're going to walk through a quick example using the percentage of completion method. This should make everything click.
So, imagine this scenario. We've got a 2-year construction contract. The total value is 50 lakh rupees. We estimate it's going to cost us 40 lakhs to get it all done. Pretty simple math, right? That leaves us with a total estimated profit of 10 lakh rupees. Okay, let's break down what happens in year 1. First, we need to figure out our percentage of completion. We've spent 20 lakhs so far, and the total estimated cost is 40 lakhs. So, 20 divided by 40, that's 50%. The project is halfway done. Now, we take that 50% and apply it to our total contract revenue of 50 lakhs. That means we have to recognize 25 lakhs in revenue for this first year. From that, we subtract the 20 lakhs in costs we've already incurred, and boom, we have our taxable profit for year 1.
And there you have it. The taxable profit for year 1 is 5 lakh rupees. And it makes perfect sense, right? The project is 50% complete, so we're recognizing 50% of the total estimated profit. Exactly what the law intended.
Okay, knowing how to do the math is one thing, but now we need to talk about proving it. Proper compliance is absolutely everything. We'll look at the documentation you need and some common pitfalls you have to avoid. Listen, if you're going to use this method, your record keeping has to be meticulous. I'm not just talking about your standard books of account. You need detailed cost sheets, all your valuation workings, progress certificates signed by the project engineer or architect, and of course the actual contract agreement itself. You need a solid paper trail.
If I can give you one major warning, it's this. I know we've said it before, but it's the most common mistake people make. Do not, under any circumstances, reduce your contract costs with incidental income. The law is crystal clear on this. Make sure your accounting process keeps these things completely separate, because I promise you, it's a huge red flag for the tax authorities.
While we're talking about compliance, there's another key change in the 2025 Act you need to know about. It's a change in terminology that simplifies things a lot. Remember the old previous year and assessment year? It could get pretty confusing. Well, forget about them. The new Act introduces a single, simple term, the tax year. This is the year when the income is earned and assessed. One term, one timeline. Much easier.
Okay, we've gone through a lot today, so let's boil it all down. What are the absolute key takeaways you need to walk away with when it comes to Section 57?
Let's run through the top 5 things to remember. First, for all construction contracts, your default is the percentage of completion method. Second, if you have a service contract, always double-check if it qualifies for one of the exceptions. Either it's under 90 days or involves an indeterminate number of acts. Third, always include retention money in your revenue calculation. Fourth, never ever reduce your contract costs with incidental income like interest. And finally, number 5, document everything. Your paperwork is your proof.
So, I'll leave you with this one final question to think about. Now that you know the clear rules laid out in the new Act, it's probably a good time to take a hard look at your own processes. Are your current accounting practices for your long-term contracts truly and fully aligned with Section 57?
That's all for this explainer. Thank you so much for watching. If you found this helpful, do me a favor and hit that like button, subscribe, and maybe share this with a colleague who might need it.
Just a quick reminder, this is for educational purposes only and isn't professional advice. Tax laws can change, so please, always consult with your professional advisor before making any decisions. This is an AI-generated educational video.